Commodity market. You might get little bored because previous chapter also had a long discussion on commodity market. But previous chapter had many other institutions and intermediaries also. This chapter is only dedicated to commodity market. Whatever formula I have given you in the previous chapter is applicable in this chapter also. Okay. So commodity market is one of the biggest derivative markets. And I have told you in one previous lecture that the daily volume of transaction is much more now than the stock market or any other market. On a single day in MCX, the volume was more than 1 lakh crore rupees. That's like a world record, okay, in a single exchange. Why people invest in commodity market? Less investment, more return. Less investment, more return. If you want to buy gold, you think gold price will rise, you will invest 30 lakh. After 1 month, gold price actually rises to 31 lakh. You'll make a profit of 1 lakh rupees. But if you buy gold future, and suppose you deposit a margin money of 10% only, 3 lakh rupees, and gold price rises to 31 lakh, still you'll make a profit of 1 lakh. Calculate rate of return. In the first example, 1 lakh you will earn on 30 lakh rupees, 1 by 30, just 3.33%. Here it is 1 lakh upon 3 lakh, 33% return. So what is better? Gold future is better. Gold and the commodity market is more popular than sometimes stock market because general public may understand commodity prices better than the stock prices. Even a best of the equity research analyst does not know what is the correct value of a share. Is it right? But an ordinary farmer also knows what should be the price of the wheat. A layman also knows what should be the price of gold and whether it is going to rise. So they have more understanding of commodity than the stock or the index. That is why also they are very popular. Okay. Trading has become very easier because of online trading. On mobile phone you can do trading. So that makes commodity market very attractive for those who like to speculate. Okay. And most of the trading in commodity market is for speculation only. Although sometimes delivery based settlement is also there. But in website I did some research what is the percentage of trade which are speculative and what is delivery based. It's almost 95 to 97% is speculative. Only they are interested in making profit due to price change. They are not actually interested in the gain the commodity as such. Okay. So you are a student, you will take position in gold, silver. You are not actually interested in gold or silver, but you want to earn profit because of price movement. First paragraph. Commodity market deals with trading of commodities like metal. So different types of metals are traded: tin, aluminium, zinc. Raw material commodities like cotton, different types of pulses, gold, silver also, bullion, agri products. These are the main highlights of commodity market. Bullion, okay, agri products, and under that also you have many products. The contemporary commodity market is as sophisticated as its stock market counterpart. That means now the technology, the sophistication, electronic trading, online trading, mobile trading for commodity is also as sophisticated as stock market, with the only distinction being what is traded in commodity market, commodity. What is traded in the stock market, stock. And as you know, commodities are more understandable than stocks. For a layman point of view, commodity is better understandable product. You can explain to the layman what is gold, silver, zinc, aluminium, onion, potato, wheat, rice. But you can't explain him what is Cipla share, what is Ranbaxy share, what is Dr. Reddy Laboratories share, etc. What is Sensex, what is Nifty. You can't tell them. In spite of all your efforts, you can't convince a layman what is Nifty or what is index. Okay. Why commodity market is required? Is it required? It is required for certain reasons. So it is in the first paragraph only and paragraph 2 also why commodity market is essential. Commodity market is essential to understand how the prices get influenced by many of factors ranging from monsoon prediction to political decisions. So it helps in price discovery. If you want to convert this into a single line, it helps in price discovery. How the prices of commodities are influenced. You can also understand by going to the commodity market. Okay. Commodity market acts as a barometer of how the market perceives these factors, which in turn will impact the demand supply dynamics, thereby influencing the future prices. So in commodity market, you will get to know in advance whether the price of a commodity is going to rise or fall. So if say silver in the market, it is 45,000 rupees per kg spot, but the future is 49,000 rupees, trading at 49,000. What is the indicator? Prices are rising. Prices are rising. Whatever factors affect the price of silver have been taken into account in determination of future pricing. Okay. So commodity market acts as a barometer of how the market perceives those factors, which in turn will impact the demand supply dynamics, thereby influencing the future prices. So now future market is used by a lot of people, traders, producers, agriculturist, farmer, to get an idea about the future movement of the prices. And this leads to a market driven price discovery mechanism. So what is the summary of these three paragraphs? Commodity market is essential for price discovery. Large number of participants are there. They take into account the various factors which affect the pricing. Monsoon on one hand to political decisions on other hand affect the pricing. See one example of commodity market. It is very useful for producers like farmer. You are a farmer, okay, and you are going to crop which will be ready in 3 months. The risk is that after 3 months, what will be the price he does not know. So he has invested his time, effort, he has purchased seed, fertilizer, water, electricity. Okay. And in spite of so much of hard work, he is not sure what price he will fetch after 3 months. So what he will do? If he is a person who knows about the commodity market, he will go to commodity market and sell the crop in the future market, lock the price and sleep peacefully. After 3 months, he is sure he will receive that much amount. Of course, there is an advantage and disadvantage to this decision. If the prices fall, still he will be able to sell at the same price. But if the prices rise, he will not be able to benefit from that rise in the price. But at least good news is that he will not suffer the loss. Okay, he has protected himself from the loss. So when you are hedging, you should be contented. When you are hedging, you should be contented. So he would sell an estimated quantity, say 100 kg of his future produce at a future rate of rupees 80 per kg, thereby assuring himself of a fixed price. So he sold 100 kg at 80 rupees per kg. This is the example of a farmer. A wholesaler into pulses will similarly like to have a committed purchase price and would enter into buy leg at rupees 80 per kg. On the other hand, there is a wholesaler who is worried that the price may rise. So he will enter into a contract to buy at 80. So these two parties will shake hand. After 3 months, market rate is 81. So who would laugh? Wholesaler. Who will cry? Farmer. Because he would have sold otherwise at 81. But anyway, even though he lost 1 rupee, at least for last 3 months he was able to sleep peacefully. What if the price would have crashed? He would have suffered a major loss. So farmer lost 1 kg, wholesaler gained 1 kg. Of course, the contracts are settled in cash. In India, mostly future contracts are settled in cash. Why? Delivery based settlement is also possible, but then there are a lot of technicalities involved. Like you have to deliver to a particular warehouse only, which are identified by the respective commodity exchange. So the one who has to deliver, in this example farmer, will have to carry his wheat or pulses to that market, deposit in that warehouse, and then that warehouse will deliver to the buyer. The buyer has to arrange for delivery. And then again, because you have GST involved in some cases, the two parties should also ensure that all respective regulations have been complied with, because it becomes a sale and purchase transaction. So whatever central sales tax, GST is applicable, octroi, you have to comply with those regulations. What is a simple way out? Pay the difference 1 rupee, close the matter. Is it right? And then the buyer will purchase from his local market. So that is one example. So commodity markets have been very useful for producers, businessmen, farmers, manufacturers. How this commodity market has evolved over a period of time. So some history is given, background. Since the ancient times, people used to trade in primary commodities like cotton, spices and livestock. The trader used to engage in future within the time frame, normally that of the harvest duration. So commodity trading is taking place since many years ago, and the period was that harvesting duration. If it is 3 months, so normally the future would be for 3 months. Later, with the advent of industrial revolution, have you studied in history classes industrial revolution? Not green revolution. Industrial revolution started in European countries when machines used to produce, okay, and the production started in mass scale, better quality products, okay, and people started trading in base metals also. And then now in 2000, the matured economies of US and UK also started to have exchange traded commodities. We'll discuss later. Exchange traded commodities. That means instead of directly dealing in that commodity, they have created a product called exchange traded commodity, which will track the price of a commodity. Which will track the price of commodity. It is similar to exchange traded funds. Okay. So a mutual fund which is traded, they track the price of certain shares. And as the group of share price goes up, you make profit. Similarly, exchange traded commodities were devised. They track the prices of those commodities. It may be one single commodity or a group of commodity. And if the prices rise, you make profit. So you don't have to actually buy the commodity. You can trade on exchange traded commodities which track the price of commodity. What was the major role of the early commodity market? Next paragraph. Early commodity market acted as a platform for enabling farm produce growers and the end buyers to interact. Both parties were worried about the price. Farmer is worried, price will fall. Buyer is worried, price will rise. So how can both parties avoid the price risk? They need a platform where they can interact, and this commodity market provided that platform. Then it enables intermediaries to engage in representing both the demand and supply side of the commodity chain. It also gives rise to a new class of intermediaries, the brokers, who will bring the farmer and the end user. There will be a broker of the farmer, there is a broker of the end user, and they try to bring these parties together. So it gave rise to intermediaries also, who brought these buyers and sellers together. And then the major role of the early commodity market was price discovery. But the same features still exist in the existing commodity market also. Today also same thing is happening. Even today also the commodity market is providing a platform where sellers and buyers can come together. It is the platform where brokers bring the buyers and sellers, and it helps in price discovery. So the added feature of course is now more regulation are there, more transparency, transactions are executed using trading platforms, electronic platforms. Okay, so that is the added advantage of today's generation commodity market. It is more transparent, more efficient. Now the question which is important for understanding, does commodity market influence the prices? This is a debatable question, because in India government has banned the trading of certain commodities, okay, especially like tomato, onion, sugar. The reason being, people believed that due to the presence of commodity market, prices rise, because many people manipulate the market and artificially they can increase the price. Okay, so therefore there is one view that because of the commodity market, the prices of agricultural item, pulses, grains or vegetables have gone up. So let us see, and then you will also think on this point. Commodity market influences prices at two levels. First is, it provides a big platform where lakhs of buyers and seller can come together as a buyer or seller, as a demand or as a supply factor, to determine the prices for a particular commodity or grade of a particular commodity. So one advantage is that it brings perfect competition. Large number of buyers and sellers interact. And second, it acting as an indicator for the produce grower to take informed decision on which product to grow to reap better prices also. So producers have also become smarter now. They will check which prices are going up. If I have a land and I have an option to produce A, B, C, D, which one I will produce? Those prices are going to rise. And how do you know the prices are going to rise? You can look at the future market. You may get a hint, you may get an indication. Next is, essentially both the above objective culminate to price discovery only. However, it is very important that information that is getting used to determine the price is real time and transmitted across the market. Now markets have become very you can say integrated, efficient. Abnormal profits you can't make. Theory of efficient market, is it right? That everybody has got the information and the information is available on real time basis. and therefore making extraordinary gain is not possible. In structured market, the market prices are close to the fair value. So markets which are structured, organized, the price represents the fair value of that commodity. So by looking at the commodity market, we will get an idea what should be the fair value of that commodity. It will not be possible that in the physical market something is selling at 100 rupees and in commodity market it is selling at 2000 rupees. Possible? To my knowledge it is not, because that will also be close to the market price only. Next is negative impact of speculation. This is one drawback of this commodity market. Lot of speculation takes place. Most people are there for speculation only because they want to make quick profit, short term gain. But in the process, it may lead to actual rise in the price of the commodity. And therefore, sometimes governments interfere also to ensure that too much of speculation does not lead to an excessive rise or an excessive fall in the price of commodity. It has happened in India. That is why some commodities are not allowed to be traded there. Otherwise, somebody will hoard it, store it, and artificially increase the price and take the benefit in the future market also. Possible? The bane of the commodity market is speculation driven trades. Means the drawback, the curse, and short selling done to gain short term profit. Precious metal like gold and diamond attract speculative investor. You are not actually interested in buying gold and diamond in the real sense, but here the fluctuation is more. Gold prices fluctuate a lot because it is dependent on the dollar value, interest rate, inflation, international prices of gold, and therefore people speculate a lot on gold and diamond. And there are also instances of black money and money laundering that mires the true feature on efficient commodity market. It is believed that in commodity market a lot of black money and money laundering takes place. Money laundering means illegal money coming from unknown sources. They enter the market for earning profit. Okay. A report released by the World Bank in 2012 has laid the blame that is the world report says that the food prices, world report is saying, I'm not saying, world report says food prices have gone up by 10% globally due to speculative trades. So imagine 10% rise is too much for a poor country like India and like Bangladesh also. Speculation cannot be ended in any market. Can we? Otherwise the whole charm of derivative market will go away. Because most people are speculators only. And speculators are required because if you want to hedge, you want to sell, farmer wants to sell, but there must be somebody on the other hand who wants to buy. And that other one can be the speculator also. We are not interested what he wants, at least I am able to sell. But speculation should be such that it does not affect the market in the negative way. So it says that the note says regulations have been imposed so that offenders will be treated with high penalties. You will get a treat. But what is a treat? High penalty. In Europe, there is a body called ISMA, European Security and Market Authority, which is based in Paris, formed in 2011, is an EU-wide financial market watchdog which aims at orderly pricing and settlement conditions. So, regulation is there everywhere, not only in India, Europe also. The individual exchanges also have brought their own check mechanisms like position limits. Write one small note on position limit. So what the individual stock exchange or the commodity exchanges are doing, in order to curb the speculation, reduce the speculation, they have brought a concept called position limit on the participant. Okay, what is a position limit? A position limit is a present level of ownership preset. Position limit is a preset level of ownership or control of derivative contracts. Preset level of ownership or control of derivative contracts like options or futures, that a trader or affiliated group of traders may not exceed. So on individual trader or group of trader, they put a position limit. You can't take position beyond a certain amount. So even though you want to speculate, you will not be able to do. Is it right? Say for example, you can only, let's say, purchase 100 lots. It will automatically curb the speculation on individual traders and group of traders. Or trade cutoffs also. They will put the timing of trading. They will put the trade cutoff. They will restrict the trading on a certain thing, etc. are introduced to discourage pure arbitrage traders. So basically the idea for putting such checks are position limit, trade cutoff, to reduce the ability of a person to speculate or arbitrage. Now next paragraph, commodity market in India. I'll go through it very quickly because this was there in the previous chapter also. So commodity markets in India, which are the main commodity markets? One is MCX, Multi Commodity Exchange of India Limited, and NCDEX, National Commodity and Derivative Exchange Limited, are the primary commodity trading platforms in India. More about these two exchanges we have written in previous chapter. So in this chapter I have done some editing, okay, to avoid some repetitions. So read chapter 6 and 7 together because they are quite interlinked only. MCX is a commodity future exchange started in 2003 and is listed on the BSE. So this itself is listed on Bombay Stock Exchange, and more about MCX is given in the earlier chapter. The shareholders, the number of trades that take place, etc. Commodities. NCDX is another exchange that is promoted jointly by, we have seen the name of all the promoters. The main are LIC, NABARD, etc. and has robust online trading system. Now underline this sentence because in ICI model test paper there is a question on this. Who has introduced an index in commodity market called Dhanya? Dhanya. अच्छा धान्य हिंदी वर्ड धान्य. Now understood. This is a question in one of the MTP model test paper. So NCDX has its own index called Dhanya. Dhanya is a value weighted index computed in real time using the prices of the 10 most liquid commodity futures traded on the NCDX platform. So they have also created an index like BSE has Sensex, NSE has Nifty, NCDX has Dhanya, based on 10 most liquid commodity future. So by looking at the index, one can get an idea about the movement of commodity market. Any index gives you an idea whether in general the market is moving up or down. and then your institute has given one screenshot also of this index. So the last was 2967.82. Today it opened at 2971. Then at the end of the day, the index went to highest point 2979.90. During the day, the index had gone to the lowest level of 2959.05. Okay. And previous close 2971. So last means today's last traded price. I'll repeat this again. Previous close means yesterday. Last here means today the index closed at this value. Closing index for today. It opened at 2971 and these are their highest and lowest point during the day. These are the 10 commodities. It is 11 actually. Whose prices are given. 10 only. 10. My mistake. I thought I must have counted this also in the line. Okay. So 10 commodities. Which are these 10 commodities? Only for understanding, they are not going to ask question on this. What they will ask, what is the index of NCDX known as? Dhanya. Based on how many commodities? 10. Which are these 10 commodities? They will not ask you. Castor seed, coriander, cotton seed, oil cake, guar seed, jeera, mustard seed, soya bean, sugar M grade, turmeric. What is turmeric? Haldi, wheat. And what is coriander? Okay, whatever. You understood, na? Don't ask me. I'm not good with these numbers, these things. I am CA, you can ask me numbers. Yeah. That does not mean I should know everything on earth. Come to the next paragraph. Problem with the Indian commodity market. Compared to global commodity market, still it lags behind. I'll tell you. The Indian markets have been plagued by the speculators and fly-by-night operators. What is speculator? You know. Plagued by means suffer from speculation, and fly-by-night operator means those who enter the market for a very short time, make quick profit and run away. They are called fly-by-night operators. Okay. Common term for the people who cheat others. That means they are only short-sighted. The chairman of the now defunct NSCL. What is defunct? It does not function anymore now. It has been banned by SEBI. It was called National Spot Exchange Limited. There was a big time fraud here. Which Shah? Whatever. There was a big fraud here. And what was the fraud? They mentioned also here briefly. And after that it was banned. That people used commodity market to make profits or transactions of thousands of crores of rupees. So the chairman had to be arrested. The institute have removed the name from this notes. Doesn't look nice. Okay, some Mr. Shah was there. You can do the research and you will immediately get it on the Google. It was in news for many days. Abhi, you want to do it now? You try, I will read it. Had to be arrested. Had to be arrested for having entered into future market. See what he has done. Without adequate documentation. Many commodities that were traded did not have any underlying to them. He is trading in future market without underlying, without documentation. My God. And what was the auditor doing? What was the SEBI or the Forward Market Commission doing at that time? Is it right? What was the government doing? Don't ask me. Everybody get their share. No, don't write that. SEBI has passed tough strictures on fresh forward contracts in the commodity market in February 2016, and it has de-recognized OTCI over the counter exchange of India. So SEBI has been little strict now. So tough regulations, de-recognition of OTCI. Now you have to do transaction only on the recognized commodity exchanges. Rules have become toughened now. Another big problem is that the commodity market have not been able to see exponential growth that is required for platforms to sustain it. We still believe there is a lot of scope for growth of the commodity market. The basic problem is of inclusion. Now explain what is this basic problem of inclusion. Farmers that form the backbone of agri-based commodities. In commodity market, agri commodities are traded, but the person who produces this commodity is not considered, are not able to connect to the market. So they should also be brought to commodity market. They should be informed about the benefit of commodity market, so that when they will grow the seed, they will take a position in the future market itself, and they will be happy, because then there is a price assurance. Even though both MCX and NCDX have created several awareness programs towards the same. So if the farmers are made aware about this market, then they will benefit. Political ramifications have also added to the woes, problems. Price sensitive commodities like sugar, onion, tomatoes have been on and off the future platform. Sometime it will be allowed, sometime it will be withdrawn. So these are the problems with Indian commodity market. So what is the way forward? What is the solution? Where are we going to head now? Commodity market in India have a long way to go to become globally competent. Still miles to cover. There is a persisting need to close the chain between farmers to the market. Okay. So that means more and more agriculturists should be brought into this commodity market, which is even more challenging given that the hold of the intermediaries is too strong in the Indian scenario. What is intermediary? The brokers. They will not allow the farmers to come to the market directly. Then where will they make profit? The problem is farmer sells to the intermediary at 3 rupees per kg. The intermediary sells at 13 rupees per kg. He makes 10 rupees profit. Farmer earns only 3. But if you remove this intermediary, both the parties will benefit, the end user and the farmer. So that is not happening because these intermediaries have a strong hold. Brokers, they have a huge control over the market. And impetus from the government is also required in order to both execute and educate and popularize the adoption of commodity market in India. So that means government should also promote it. They should hire some brand ambassador, like Amitabh Bachchan, and they should tell them how this commodity market can be useful to them. In the Man Ki Baat, the Prime Minister should also say that you should use this commodity market and get benefit. Okay, don't write that. Regulatory scenario in India. So which are the regulation we have already discussed in previous chapter. Earlier Forward Market Commission was there. Now it has merged with SEBI. So SEBI is the boss now. The government, considering it wise to bring the commodity market under a common regulator, repealed the Forward Contract Regulation Act. So this act does not exist. And the regulation of the commodity derivative market shifted to SEBI under the SCRA with effect from 28 September 2015. This was the period when a lot of scams took place. That scam which you read just now, National Spot Exchange Limited scam, Jignesha. Oh, Mr. Jignesha was the brain behind this scam. Yes, small heighted. How do you know? So you've read about. I thought he's related to you in some or the. Then I would have been careful. Okay. Yes, all great people are small heighted only. Now come to difference between commodity and financial derivative, but we will take a small break.